Let's finish off chapter 15 with part 2 of the lecture. This is the second part of our lecture on shareholders' equity. Let's talk about dividends. So there are two types of dividends. There's a return on capital, which is where a company pays out dividends out of their earnings or their net income. And there's a return of capital, which is a liquidating dividend. When a dividend is paid out, it will reduce the shareholders' equity of the corporation. Both types. A declared dividend is a liability, and we'll talk about that in a minute. Dividends are declared as a stated value or an amount per share, and they're not paid on treasury shares because those shares are being held back by the company from the market. So of course you wouldn't pay a dividend to themselves. The company wouldn't pay a dividend to themselves. So when we think about dividends, there's three important dates that we need to remember. So there's the date of declaration. So on the date of declaration, this is when we're going to record the dividend. So it's going to decrease our equity section, and it's going to be recorded as a dividend payable. So when the board of directors says we will pay a dividend of $10 per share, the date that they declare that, that's the date we're going to record the liability for the dividend. There's also a date of record, which is the date of the cutoff for who the eligible shareholders are for the dividend. As we know, the shares of publicly traded corporations change hands often. So there has to be a date at which they lock down the share register and say, okay, this is the date of record for the dividend. There's no accounting entry on the date of record. And then the date of payment is where we're going to clear out the payable and we're going to actually pay out the dividend in cash to the shareholders of record on the dividend date. So let's look at an example of a cash dividend. So on June 10th, the corporation declared a cash dividend of 50 cents a share on 1.8 million shares payable on July 16th to all shareholders of record on June 24th. So you can see we've got our three dates there. We've got the date the dividend was declared, we've got the date of record for the shareholders, and we've got the date that it was paid. So the first journal entry is on the declaration date, so June 10th. And so on this date, we're going to record debit dividends. Now, you can have dividends or net income here. In the chapter, they're using this account dividends, which is really just illustrative. Regardless, it's debiting shareholders' equity. So that means you're decreasing your equity. As we know, we've got a credit balance in our equity section. So a debit is decreasing that section. So you could have a debit to net income, or you've got a dividend account here, which is just going to close out to net income. It's just for illustrative purposes so that a reader of the financials can understand what the dividend transactions were. So we've got debit dividends and credit dividends payable. So we're setting up a short-term liability in our liability section on the statement of financial position that we're going to pay out in the next year. We know that it was paid out on July 16th. And this is going to reflect the timing difference of the payment. So we're going to recognize the liability first. We've got the date of record for all the shareholders on June 24th, sorry. No entry there. That's really just bookkeeping, or it's really for the transfer agent to figure out, who's eligible for this dividend. And then when the dividend was paid on July 16th, then the liability is going to be cleared out. So it's simply going to be debit dividends payable. So we're going to remove the liability from our statement of financial position, and we're going to recognize a credit to cash. So we're paying out the cash, our cash goes down, and the liability is now gone. You can also have a dividend in kind. So dividends in kind are payable in corporate assets other than cash. So maybe they're going to pay the dividend in merchandise or real estate or investments. Oftentimes it's in investments of other companies that they will give to the shareholders. It's generally measured at the fair value of the asset given up. And the nice thing is, in the questions, it's going to kind of need to direct you as to how to measure the dividend in kind, which is a positive thing about a textbook example. You can also have a stock dividend, and this is where rather than paying out the dividend in cash, they basically give all the shareholders more shares. It won't change the proportionate share of any of the shareholders in the company. So if you had a 10% interest before, you're going to have a 10% interest after the stock dividend because of the fact that it's equal across the entire class of shares. And the company's book value doesn't change. You're not inflating your assets somehow by issuing a stock dividend. The book value of the shares will be lower just because there's more shares. So you used to have one share worth $10. Now you have two shares worth $5. You still have the same ownership, but each book value of the share is lower. And this does result in an increase in the number of shares outstanding and the share capital with a reduction in retained earnings. It's just a reclassification within the equity section, which we'll see in a minute. And if the dividend is large enough, there could be an impact in the marketplace, but it's unlikely. So here's an example. We've got a company has 1,000 common shares outstanding and retained earnings of $50,000. A 10% stock dividend is declared. The declared amount of the dividend is the fair value, $130 per share. The shareholders had the option to take the dividend in cash, but chose not to. So at the date of declaration and distribution, they would record debit dividends. So again, we're debiting our shareholders' equity section. So we're decreasing our shareholders' equity, and then credit common shares. So we're increasing the amount of common shares that we have. So we're really just reallocating within the shareholders' equity section. So your total equity hasn't changed. You just you've reduced the dividend account and you've increased the common share account. And the dividend is measured at the fair value of the shares on the date of the declaration. So you can see there were 1,000 common shares outstanding, and they issued a 10% stock dividend, and the average price of the share or the fair value is 130. So that's how we calculated that 13,000 there. And this slide illustrates the fact that each shareholder has the same proportionate interest in the company before and after a stock dividend. So we can see before the dividend, our total shareholders' equity was $150,000, and we had $100,000 in common shares and $50,000 in retained earnings. And then if you look at the after declaration, we still have $150,000 in retained earnings, but down here, you can see our common shares increased to 113 and our retained earnings decreased to 37. So you can see how the stock dividend is just reallocating within our total shareholders' equity. So we still have 150,000 of total shareholders' equity in both circumstances. And then if we look at the shareholder interests, previously shareholder A had 40% 40% interest, B had 50 and C had 10. And if you look at the very bottom section, you can see the 40, 50, and 10 are the same percentages, but you can see that each shareholder now holds 10% more shares because it was a 10% stock dividend. So shareholder A used to have 400 shares, now they have 440. Shareholder B had 500 shares, now they have 550, and so on. So you can see this really just illustrates the concept of a stock dividend, meaning that each person receives a proportionate number of shares, so everyone gets an extra 10%, which means that their overall interest stays the same, but they do end up with more actual shares. Stock splits. So stock splits can happen when stock appreciates rapidly and significantly. And so a very high stock price can make it hard for a new investor to buy into the company. So what some companies do is they do a stock split, which is where you say, okay, well, you have one unit worth $100. Now we're going to give you 2 units, each worth $50. So you still have $100, but now the actual individual price of the stock is lowered down to the $50, which might make it easier to raise more capital and attract more investors. So from an accounting standpoint, where there's a stock split, the company has to issue a memorandum note, and it has to be included in the notes of the financial statements to indicate the number of shares has increased. Liquidating dividends. So liquidating dividends are where a dividend's paid out of contributed surplus. And if we remember back to part 1 of the lecture, contributed surplus is like a bonus account in our equity section. So if we purchase shares for less than what we received when we issued them, then we end up creating this extra account in our shareholders' equity section called contributed surplus, which is where we record that excess, like the extra amount that we earned on those shares through mostly through reacquisition transactions. And so dividends can also be paid out of contributed surplus, but this means that the company is returning the shareholders' investment. So this is a return of capital. This is the second type of a dividend. It's not returning, it's not issuing funds that, or it's not issuing earnings from net income. This is actually returning capital to the shareholders. So for instance, here's an example. A company issued a dividend of 1.2 million to its common shareholders. 900,000 was considered to be a return of income, while the rest represented a return of capital, meaning contributed surplus. So at the date of declaration, which is when we need to record the liability, we're going to debit retained earnings or dividends. They're just illustrative accounts. And so we're decreasing our retained earnings or dividends, whichever account we choose, for 900,000. Because it says 900,000 was considered to be a return of income, meaning it's going to go through retained earnings or this illustrative dividend account that we have in our shareholders equity section. Then the remainder, which would be 1.2 minus 900, which is 300,000, is going to be paid out of contributed surplus, which is why it says a return of capital. And then the total of those two amounts is going to be recorded as a dividend payable on our statement of financial position until we actually pay out the dividend in cash, which is always done at a later date. Dividend preferences. So you can have situations where, so something that we know from part 1 of the lecture is that preferred dividends, so participating preferred dividends, they have to have their dividend paid out before any dividends paid out to the common shareholders. Now we know that there's no liability recorded until the dividend's declared. So even if you know that the preferred share is cumulative, that the board of directors still has to issue the dividend. But if they don't issue the dividend 1 year, then the dividend has to be caught up for the preferred shareholders before any dividend can be issued to the common shareholders. So let's take a look at an example of that. So $50,000 is to be distributed as a cash dividend. Outstanding common shares have a book value of $400,000 and $1,006 preferred shares are outstanding. So you can see what scenario number 1, preferred shares are non-cumulative and non-participating. So we've got the total dividends declared are $50,000. The preferred shares have to be paid first, which is 1,000 times $6, because the reason that it's $6 is because when they were issued to the market, they were issued as a $6 preferred share, meaning that they have dividends, meaning that they would pay a $6 dividend per year. And of course, like we said, no liability until it's declared. So in this situation, it's year 1. So we're going to pay the $6 dividend, and then the remaining of the dividend can be paid out to the common shareholders. And so this kind of also illustrates why sometimes it's advantageous to be a preferred shareholder and sometimes it's advantageous to be a common shareholder, because there's clearly a lot more dividend going to the common shareholders here, but the preferred shareholders have the guarantee of the $6 dividend. If not each year, then they'll be caught up. So it's really a trade-off between the two classes. Here's a scenario number 2. So same scenario, $50,000 to be distributed as cash dividends. Outstanding common shares have a book value of $400,000. $1,006 preferred shares are outstanding. And it says preferred shares are cumulative and non-participating, and dividends on preferred shares are not paid in the previous 2 years. So what it means when it says cumulative, that's where we were talking about how it has to be caught up. So if it didn't pay it for the previous 2 years, then it has to be caught up for those 2 years before the common shareholders can be paid a dividend. And it says non-participating, and what that means is they don't get to share in any of the dividend that's being paid out to the common shareholders. So they're just limited to their $6. They get caught up, but that's it. So let's take a look at what that looks like. So we've got our total dividends declared here of the $50,000. We've got the fact that we need to pay out the preferred shareholders dividends in arrears. So the 1,000 times $6 times 2, because there were 2 years that we didn't pay. So we now owe them for 12,000. And then we also owe them for the current year. So we want to make sure we didn't miss that, because it says the previous 2 years, but then now we've got the current year. So now we've got the 1,000 times the $6. So the preferred shareholders are going to receive 12,000 and 6,000, or 18,000 total. And the remainder is going to be available to the common shareholders. So in this situation, they'll receive this pool of the dividend of 32,000, which of course will have to be divided by each common shareholder. One more scenario. Now we've got preferred shareholders that are cumulative and fully participating. And the preferred dividends on preferred shares were not paid in the previous 2 years. So cumulative, we know what that means, the catch up, but fully participating means that they also share in the dividend that's paid to the common shareholders at the same rate, if it's better. So let's see what that looks like. So we've got the 50,000, we've got our 12,000 here for the dividends in arrears. Now they've got the 38,000 available. This 6,000 we saw in the previous question. So this is the preferred share, the preferred dividend for the current year. And then now we've got the common share at the same as the preferred dividend, which is 6% times the 400,000, which would give us 24,000. So now at this point, everyone's equal. So it means that the preferred shareholders and the common shareholders have received a proportionate dividend, making it equal, so to speak. So now what we're going to do is we're going to issue the remainder of the dividend proportionally. So we know how many shares we have of the two, or what the book value is of the two shares. And we've got this 500,000 here, which is the total number of shares, I think. No, the 500,000 is 50,000 to be distributed. 400,000. Yeah, so the common shares were issued, have a book value of 400,000, and the preferred shares were issued for 100,000. That's where we get this 500,000 that we're dividing by for the denominator. So that gives us the proportionate split of the two shares, like what the percentage of shareholders are. And then now we're going to divide up the remaining $8,000 dividend between the two classes, meaning that the common shareholders get 6,400 and the preferred shareholders get 1,600. And that takes care of the entire dividend. So you can see how when preferred shares are fully participating, it definitely makes the calculation more complicated, because now we don't just say, okay, well, we'll pay out the preferred shareholders, then we'll pay out the common shareholders, which is much more simple. This is where we say, well, we'll pay out the preferred shareholders first, and then whatever we have left for the common shareholders, we need to make sure that it's equal. They're both going to share in that. So that's what's illustrating here, and we'll look at some questions in the tutorial as well. Okay, one more scenario here where we've got $50,000 to be distributed as cash dividends. Same example here, and then it says preferred shares are non-cumulative and fully participating. So if they're non-cumulative, it means there's no catch-up. So in the previous question, we had been told that they hadn't paid out the preferred share dividend for the past 2 years. Well, here they're saying they're non-cumulative, so they don't get a catch-up, but they are fully participating. So it means that of the 50,000, the preferred shareholders and the common shareholders need to proportionately share in that equally. And we use the book value of the shares as the basis. All right, learning objective number 3. So here we're going to understand how shareholders' equity is presented, disclosed, and analyzed. So components of shareholders' equity includes the following. We've got share capital, contributed or paid in capital. We've got contributed surplus, which is the amount that we receive from those previous share bonus transactions. We've got retained earnings, and we've got accumulated other comprehensive income, or AOCI, which is which may be related to investments, accounting for investments, or other things like that. So presentation. So in IFRS, we have to present in our financial statements a detailed statement of changes in shareholders' equity. So this shows all the transactions that have gone through shareholders' equity in the year. And ASPE requires a statement of changes in retained earnings and contributed capital changes in the notes. So we're required to provide a lot of the same information. It's just presented slightly differently. With IFRS, of course, requiring the most disclosure. Transactions affecting shareholders' equity. So for contributed surplus, so where does contributed surplus come from? Par value shares and or retirement. treasury shares, liquidating dividend, financial reorganizations, stock options and warrants, issues of convertible debt, forfeited share subscriptions. So we looked at some examples where we had a share sold in subscription, meaning that we agreed to take a down payment from shareholders, but we didn't actually get all the money up front. So if someone defaulted and it said in the share agreement that we would not refund their money, then we would record that to contributed surplus. And other examples. I don't think we need to focus too much on the appendices here. I think if we focus mostly on the presentation of this section, and then make sure that we're comfortable recording and creating a statement of changes in shareholders' equity, then I think that will get you farther than going through the appendices in great detail. And we'll talk more about that as we go through the tutorial section. So transactions affecting shareholders' equity. So there's a few different transactions. There's a net loss will obviously decrease our equity. Net income will increase it. If there's a prior period accounting adjustment or a change in accounting principle, then that could decrease it or increase it depending on how that transaction is playing out, if it's a negative or a positive impact. Cash, property, or most stock dividends often will decrease retained earnings. Again, if we're paying out a cash dividend, we're distributing either our retained earnings, or the income that we've earned in the business, or a liquidating dividend. Those are all going to decrease our equity. There could be a positive adjustment to equity based on a financial reorganization, and some treasury share transactions could decrease shareholders' equity. So what transactions impact accumulated other comprehensive income, which is a component of shareholders' equity? Well, there's cumulative changes in equities due to revenue, expenses, and gains and losses from non-shareholder transactions included in net income. There are, so our net income, of course, is going to increase shareholders' equity. Our earned income is going to increase net income through the equity section. Some income that hasn't been realized, and this account is included in the statement of changes in shareholders' equity under IFRS, but there is no AOCI under ASPE. Capital disclosures. So in the statements, we need to disclose the number of authorized, issued, and fully paid shares. We need to disclose any rights, preferences, or restrictions, and a reconciliation between the opening and closing balances of our accounts. We also need to disclose any restrictions on retained earnings or dividends. And under IFRS, we also have to disclose our objectives, policies, and procedures for managing capital, and a summary quantitative date about what the company manages as capital and any changes. We also have a few ratios that we can use to analyze the capital section of our statement of financial position. So we've got the rate of return on common shareholders' equity. So this shows how many dollars of net income were earned for each dollar invested by the owner. And this is where we take the rate of return, where we take net income minus the preferred dividends, and we divide it by the average common shareholders' equity. We've got the payout ratio, which is the ratio of cash dividends to net income. If an investor wants to know what the probability is of them getting a dividend, or what the payout ratio has been in the past, they can look at it over several years to get a trend, which is where you take the cash dividends paid to common shareholders divided by net income less preferred dividends. And also we've got a dividend yield, which is a rate of return in the form of cash dividends. And it's the cash dividend per share divided by the market price. Price earnings ratio is used in discussing the investment potential of an enterprise. So if you want to know how much the stock is going to appreciate or how it's been trending over several years, again, that's the only way that any of these ratios really have any meaning, is when you look at the trending. So this is where you take the market price per share divided by the earnings per share. And also you could look at the book value per share, which is the amount that the investor would receive if the company was liquidated. So if you're looking at buying in for $100, would you get back your $100 or would you get back $5? And this is where you take the common shareholders' equity divided by the number of shares outstanding. Last but not least, learning objective number 4. So this is just considering any differences between IFRS and ASPE. It's a very short learning objective because there are very few accounting differences for equity. We did look at a few differences throughout the chapter. Most notable differences are that IFRS still requires more disclosure around equity. We have to prepare a formal statement outlining all the changes in shareholders' equity. And ASPE does not have AOCI, or accumulated other comprehensive income. Is not a concept in ASPE, where it is a concept in IFRS. And other than that, there aren't really any significant differences. There is more guidance provided around ASPE for share repurchases, but IFRS basically conforms through a different way, which is looking at the conceptual framework. But there's not too many really significant quantitative differences here that are going to come out in an exam question. Looking ahead, the IASB is continuing to look at several projects, including the primary financial statements project, and looking at if there's enough disclosures or how equity should be presented. And that's it. That concludes the second part of the Chapter 15 lecture. Please join me for the tutorial section, where we will work through some questions about the material we just covered.